Hey, it's Rick. It's Sunday afternoon around 4 o'clock. And as I often do, I'm in front of my screen looking at charts. A couple of you asked me this week, your GICs matured and you're sitting on a pile of cash. And is it time to jump into the market? And since we're working off the weekly charts, because these are RSP investments, um, I said, let's wait till the weekend and maybe I'll do a little video for you. So here we are. But first off, I stepped back for a minute and said, what is a possible strategy that I would encourage you to use for your index, what I would call index investing. So it's in a Word document that's attached to the email that I sent out. And I'd highly recommend actually you pause the video at this spot and go back. If you haven't done so already, open that document and read it, and then come back to the video. It might make a whole lot more sense to you. So I'm going to go on that premise as I pick this up and go through the chart. But if you don't want to do that, then you're going to watch the video, read the Word document, then maybe want to come back to the video again to help understand it. So with that in mind, here we go. So the premise, well, let me just bring this back up again very quickly. The objective is we want to beat the S&P benchmark, and we want to protect our capital, and we really don't want to make many changes to our portfolio, especially since we want to keep your time involvement, I say, to less than 15 minutes per week. And actually, as I study these charts, it's for 98% of the weeks, it's less than that. You can do this in 2 or 3 minutes. So the rules are basically be 100% invested if the ETF price that you're using as your benchmark is above its 40-week moving average, and you sell it and remain 100% cash when the ETF is below the 40-week moving average. So very, very simple rules, and then there's some other tactics to follow along beside that. So let's just review how this works. So let me just hide this and go back to the chart. So I have the S&P 500 here. It actually goes back to 2017. But basically, as long as you're above this, I'm going to remove the 10-week moving average, and we're just going to stay with the 40. So as long as we're above the 40-week moving average, you're fully invested. When you get below, you go to cash. When we get back above it, we get back invested again. Very, very simple. So let's just sort of take a real life example, if you like. Following the COVID disaster in the market, we had this rebound and then settling in, and we finally got above a rising 40-week moving average somewhere here around June of 2020. So the moving average, of course, was rising here. It only fell off a little bit, but was flat, and now it's started to come back up again. So now your attention is focused on the market. So I'm going to assume $100,000 account for simplicity's sake. And so here is we're above the 40-week moving average. We'd probably be buying it this week right here, the week of July the 6th, as it gets right about here, with your stop then at the moving average at that time, which would be 302.83. And you'd be buying it at, what did I say, about 318. Let's give it a little fudge. So you'd have about a $16 stop, which in percentage terms is about 5%, which would be about standard. So you're in. Now, every week thereafter, the only thing to do is to take the next week's bar and see where the moving average is. I mean, clearly, it takes you like half a second to say, are we above the 40-week moving average? Yes. Second question, where is the 40-week moving average? Well, it is currently this week at 302.83. So I adjust my stop. I've got a good till cancel stop in at whatever it was the previous week. I adjust it to 302.83. So it takes you a couple of minutes to go into your brokerage account and just modify the stop order. The next week, are we above the 40-week? Absolutely. What's the moving average price? Well, it's increased to 303.45. Okay, go into your brokerage account, adjust your stop to 303.45, and so on and so on and so on. And here it gets a little dicey. You see a big red bar, the moving average. Your stop is way down at 307.80. And then you see this big red bar, but is price still above the 40-week moving average? Yes. Okay, do nothing. The next week comes by, we're getting a little more nervous. It's still headed down, but the moving average is still moving up. It's now at 308.38. So that's where your stop goes to. And the next week, we're down again, but the moving average is still climbing. It's at 309.02. So if worst case, if it plummets the next week, you're going to get stopped at 309, you're in at 318. That's like a 2% loss. So not a big deal. But in fact, we do recover. And then we have another oopsies. But again, the same premises. First question, are we above the 40-week moving average? And is the 40-week moving average rising? Answer is yes, do nothing except raise your stops. And so that is the picture for quite some time. Several weeks, in fact, as we just keep on rising it up. Every week you spend a couple of minutes just adjusting your stop to the moving average. So by the time March of 2021 comes along, your stop is now at 348. So you're guaranteed to be up at least 10% from your original purchase. And we keep on going. And answers, the question is, are we above the 40-week? Yes. Raise your stop. Oops. I'll just fast forward this a little bit. What have happened this week? This week here was January 2022. The previous week, our stop would have been at 441.75. And we went through that price. So I'm assuming that we sold the 314 shares that we bought way back here at $441. And so now our account balance at the end of that day is 138,500. So we're up 38 grand, which, I mean, this is anybody could have made money in 2021. But this is an example of how this works. So now we fast forward a little bit. We say, well, when are we going to get back in? Potentially this week, we could have looked at this and said, we're back above the 40-week moving average. So maybe I'll buy next week. But I want to see, my logic is anyway, I want to see some confirmation. I want to see it get above last week's high. So if it does that, I'll put a buy order in at around 457, and my stop will be at the moving average, which is at 443. Well, we didn't take it out and we went down, so cancel that idea. And then go forward. And again, we have a situation here. Okay, price has gone above the 40-week moving average, so we can consider a buy if we get some more strength. Because now we're really close to the 40-week moving average, but this is a good place to buy when your risk is tiny. The spread between your entry price and the stop is like less than 1%. So what would have happened? Well, you would have been in and then right back out. So basically, I didn't even mark that one down because that's basically a scratch trade, what I call a scratch trade. You've been in and out and for no gain, no loss. Now, though, you're doing your weekly review. What's happening? The 40-week moving average is trending down. So there's absolutely nothing to do. You're still sitting on your 138,500 in cash. And so your decision every Friday night, Saturday, or Sunday, whenever you're looking at it, it takes less than 30 seconds. I'm doing nothing next week. I'm doing nothing. Even as we get up here, getting close to the 40-week moving average, because it's declining, you're not buying. But at this point, you might want to say, well, we'll add the 10-week just in case. We see it, because my other rule, if you've read the document, is if the 10-week crosses above the a flat 40-week moving average, you might want to consider a buy. But we're not. It's headed south. So I can just take this 10-week off because it's a distraction. And so keep moving forward. Okay, now we're getting close to again, but the moving average is going in what direction? It's heading down. So even if it goes, price goes above, I'm just not interested in buying. Goes above, oh, gets rejected. Still nothing to do. As long as that moving average is declining. Okay, we go above again, but it's still declining. Do nothing. Oh, and say, oh shit, I shouldn't have listened to Rick. It's going back up, but the moving average is declining. So stick by the rules. Go forward a few more weeks. Now what's happening though is interesting. The moving average has now started to flatten out. So if we put back the 10-week, we do see that it crossed here. So potentially back here, this week here, but we could have bought this, or I'm assuming we would have bought it. We would have bought 338 shares at $409, which is now right up in here. So as it gets like a fair distance above the 40-week moving average, I'm prepared to buy it. So we buy it at 409. We go forward, and we start to immediately regret that because it took out the moving average. The 1, 2, 3, 4, 5, 6 weeks later. So we took a tiny loss. Our account balance went from 138.5, we're down to 132.5. So we lost $6,000. So it's about 6%. Well, 6% of our original capital, but a lot less than that of our new capital. Go forward. And again, now I buy. The moving average has started to turn up. You would be buying it probably in around here. I'd say at 410. I suggested 410. That's this level right here. And your stop would be down here at, what's the moving average? 390, 350. Go forward. Nice move up. So again, we're nothing to do every week. You're just looking at this saying, am I above? Yes. Where's the moving average? I've raised my stop to that level. So it doesn't take much time. Let's get this out a little bit. And then, whoops, we went below the moving average here. So we're forced to sell. So we sold at 423. So we made a little bit back, but not much. And we're now back in cash, but we still have a rising 40-week moving average. So I'm paying attention every week a little more closely than was back up in here. So we're paying attention. We're looking for potential opportunity to get back in, and we get it this week here. We get a close above the 40-week and above the 10-week. So we're back in, I say it. I think I said 441 so it gives it a little bit of extra room. And again, this is what happens. There. Now it gets real easy. We're just making a decision every week where to put our rising stop loss order. Gets a little nerve-wracking in here, but we didn't take it out. The moving average this week is at 505.31, and the low of this week was 510. So we stayed above it. So you'd still be fully invested. So using this as an example, your account value now, as of past Friday, would be 171,000. So you're up 71%. So I think hopefully that that helps explain it. I tried to put it in dollar terms so you can actually see what the result was. Now, it is interesting if you had just done a buy and hold, just bought the 314 shares post-COVID at $318, spent your 100 grand and didn't touch it. Your actual value today would be $174,000, which is slightly above the strategy of being in and out. So you might argue that shit, I'll just stick with the buy and hold strategy. The thing about that is we didn't really have a big downside move. We didn't get any 35% corrections. And then that's what this whole strategy is designed to protect you from, is capture the upside, but really avoid the big, huge downsides. So what those of you that are using an investment advisor and you've had one for more than 4 years, I would encourage you to look at your account statement going back to roughly June, July of 2020 and see what your account has done since, say, July 1st, 2020 to today, assuming you were still with the same advisor. And if you're indeed up more than 71% from then, the strategy is like stick with your advisor. He's doing a bloody good job. But I suspect that's not the case. That the performance will be a lot less. But I don't use one, so I can't really comment there. But I would encourage you to take a look at it and see. So anyway, I hope this helps explain the document that I attached. I'm trying to keep this really simple. In fact, so simple. I'm going to encourage my 13-year-old granddaughter to perhaps open an account for her and have her follow this and see if a 13-year-old can follow these kinds of rules. Okay, that's it. So what do we do for next week? For those of you that are in cash and now looking to get back in, it's between a rock and a hard spot. It's clearly we need to be, or we should be, fully invested. However, right now the distance from the let's say you entered Monday morning at 5:55, let's say, and you placed your stop down here, it's a little over 8%. That's a big distance, especially when you get to, if I flip this to a daily chart. Let's see what's going on here. Here we go. This move, I want to take off all these drawings. Move those drawings. This move here has been rather parabolic in the last couple of weeks. I'm going to change that to white. And a good uptrend goes at about a 45-degree angle, something more like this. Yeah, that's a nice solid uptrend. When you get these parabolic kind of moves, it's just not sustainable. It can go longer than you think, but really, I'm expecting this to sort of settle in here, and maybe even come down a bit, get closer to this. If you draw a line from 45 degrees, and so you get on a weekly chart, we get a better entry, perhaps. In the next 2 or 3 weeks, we may actually pay a higher price than what it currently is. It may be up, above this, but the distance between the entry price and the 40-week moving average will be closer, which means your stop is tighter, which means there's just less dollar risk. Right now, I just see too much dollar risk of this coming right all the way back down. So that's my 2 bits worth there. But remember, I'm not a financial advisor. I don't give advice. You're on your own with respect to that. But I'd say there's no harm in hanging tough for another week, maybe even 3 weeks. Okay, that's it. That's all. Have a great rest of the weekend, and maybe I'll do another video next week for a couple of you that are a little more active in your so-called trading accounts. But again, it comes back to what is your strategy? You really need to have a clearly defined strategy so that you can track your results. Okay, cheers.